Hello everyone, a very warm welcome to you for visiting my channel, CA Amit Parekh. Today I will be sharing my views on ITR1 utility recently released by the Government of India for assessment year 21. So first we will visit the income tax website and see where and how it is notified. The ITR1 utility www.incometaxindiaefiling.gov.in. Here we need to go in here ITR form preparation utility software. Here they have already we have selected 2122 and we see that there are two utilities which have been yet notified by the Government of India. So in this video we'll cover ITR1, then in part 2 I'll be taking you through ITR4. So now they have written that it is for individuals being a resident other than not ordinary resident having total income up to 50 lakhs, having income from salaries or one house property, other sources, interest, etc., and agricultural income up to 5,000 rupees. As additional, there are some other conditions also. So let us see what exactly the conditions are. Those who are the individuals who cannot file ITR1. That is what we'll focus on. Remaining, once we go to the list of individuals who cannot file ITR1, remaining everyone can file ITR1. So here we have individuals who cannot file ITR1 for AY 21-22. First point is individuals having total income more than 50 lakhs. Total income means it is the sum total of all income received by an individual from various sources of income, that is house property, salaries, capital gains, business profession, other sources. After that, all the taxable income is added and then we have to reduce the deductions, that is investments made by the deductee, which are permissible under section 80C, 80D, etc. etc. So once we reduce the deductions from the gross total income, we get total income of the individual. And that total income, if it is more than 50 lakh rupees, then the person cannot file ITR1, he has to file ITR2 or ITR3. Now the next point. Individuals who are not resident, non-resident or not ordinary resident. If an individual is a non-resident, that is, he is not resident in India as per the income tax laws. In the Income Tax Act, the specific criteria is given for individual to be treated as resident or non-resident. So if he is a non-resident, he cannot file ITR1 even though he has only salary income or only house property income. Even if he is partly resident, that is not ordinary resident, still he cannot file ITR1. He has to file other ITRs. Next. Individuals having income more than one house property, from more than one house property. If an individual is having two houses and income from two house property, he has to compulsorily file ITR2. He cannot file ITR1. But in this case, there is one exception. If a person is having two house properties, but he is having income from only one house property, then still he can go for ITR1, because at the end what is important is we are showing income from how many property. One house property government is allowed to be shown without any income as self-occupied. So if an individual is having two properties out of which one is self-occupied and there is no loss involved in that self-occupied property and there is income from the second property, that is rental income, then in that case he can file ITR1. He can disclose the rental income in ITR1 and he can file ITR1. Next point. Individuals having income from business or profession or income from capital gains. Such individuals have to compulsorily file either ITR3 or ITR4. And later on we'll see who all are eligible to file ITR4 and ITR3. But at least these people cannot file ITR1. Next is individuals having agricultural income more than 5,000 rupees. See, agricultural income is exempt from income tax. There is no income tax on agricultural income. But there are other income also which are tax free, like interest on PPF account. Even if a person is receiving a lot of interest from PPF, for example, more than 1 lakh, still he can file ITR1. But when it comes to agricultural income, they have made a specific provision that if the agriculture exempt income is more than 5,000, then we have to file ITR2. So in this case, ITR2 is required. Next, individuals who are directors in a company. Company over here includes four types of entities: listed company, unlisted public company, private company, one person company. If a person is a director in any of such companies, then he cannot file ITR 1. He has to file ITR 2 or 3. Individuals who are holders of unlisted equity shares. If a person is having any type of equity shares in any type of three companies, that is private company, one person company, or public unlisted companies, he cannot file ITR 1, because in that case he has to disclose his assets, and there is no provision to disclose assets in ITR 1. Next comes individuals having deferred income tax on ESOPs. This is a very important point which has been brought in from this assessment year only. ESOP means employee stock option plan. Employees who are performing well receive ESOPs as incentive from their employers, that is equity shares. When they receive, they have an option either to avail or not to avail the ESOPs, that is either to take the equity shares or not. So actually previously these ESOPs were taxable when the employee exercised his right to get the equity shares. Okay, and currently also it is taxable, but with this assessment here, what they have done is that they have given more time to pay tax. The reason being, when the employee gets the equity shares, he doesn't have liquidity to pay the tax. He cannot pay the tax because there is no money, only shares have come. So the government has given three conditions, the earlier of which he has to pay the tax. The first one is when he sells those ESOPs, equity shares in the market, he has to pay tax on the equity share received from his employer. On that, he has to pay tax when he sells the ESOPs. But if he doesn't sell the ESOPs, and there are 4 years have elapsed since he got the equity shares, then also the taxability arises and he has to pay tax within 14 days. The last condition is if he doesn't sell, if the 4 years is also not gone, but he leaves the company which has given him the equity shares, then he has to immediately pay the tax within 14 days. So either of these three conditions, whichever is earlier, from that date within 14 days he has to pay tax on the ESOPs received. So any person who is in receipt of such ESOPs, he also cannot file ITR 1, he has to file ITR 2, 3, or whichever is applicable. The last point for ITR 1, those who cannot file ITR 1s. See, there are some individuals having TDS deducted under section 194N. What is 194N? It means TDS on cash withdrawals from bank exceeding 1 crore rupees in a year. So there are some high net worth individuals who withdraw a lot of cash from bank for their business use or personal use. In that case, there is a specific provision inserted from this assessment here saying that if a person is withdrawing more than 1 crore rupees in a year from the bank, then the bank is liable to deduct TDS from the cash withdrawals at the rate of 2% of the total cash withdrawals. If the amount of cash withdrawal does not exceed 1 crore, that is, it is 99 lakhs, then 0 rupees will be deducted by the bank. But if it exceeds 1 crore even by 1 rupee, then 2% of the total cash withdrawn will be deducted as TDS by the bank. So, when any person has such TDS deduction done, then in that case also he cannot file ITR 1, because to take the refund of the TDS or even to use take credit of the TDS, he has to file ITR2 or ITR3, whichever is applicable. So this is all the cases. We have understood all the cases where the individuals cannot file ITR1 and they have to file other ITRs. Apart from this, 9 cases which we have discussed, if individual is having other income, then he can file ITR1. Okay. In the next video, we'll see the eligibility to file ITR4. Which people can file ITR4 and those who cannot file ITR1. Thank you.